All right, it is 4:01 and it is time to call to order this afternoon's session of the Washington History Seminar, Historical Perspectives on International and National Affairs. This afternoon we'll be focusing on a new book published by MIT historian Caley Horan entitled Insurance Risk Era, Risk, Governance, and the Privatization of Security in Postwar America, published just a number of months ago by the University of Chicago Press. And joining us this afternoon are two discussants, Devin Ferguson of the University of Missouri and Scott Reynolds Nelson of the University of Georgia. I'm Eric Arneson from the George Washington University, co-chair of the Washington History Seminar. My colleague, Christian Osterman of the Wilson Center, is not with us this afternoon. The Washington History Seminar is a collaborative venture of the Woodrow Wilson Center's History and Public Policy Program and the American Historical Association's National History Center. And for over the past decade, the seminar has been meeting weekly, usually on Mondays, in pre-COVID times, in person at the Wilson Center, and since pandemic restrictions, here in the virtual realm. Behind the scenes are two people who make these seminars possible, Pete Bierstecker of the Wilson Center and Rachel Wheatley of the National History Center. And I'd like to thank an institutional supporter, the George Washington University Department of History, as well as a number of anonymous individual donors. And as we say every week, we invite you to join their ranks. On the logistics front, please note, today's session is being recorded and can be soon found on our institution's respective websites. And when we get to the question and answer section of the webinar, we ask those of you with questions to use the raise hand function, which is our preferred method. That way we get to call on you and you get to pose your question, or you can use the Q&A function on Zoom. We ask you not to use the chat function. If you use the Q&A function, I get to read your question, not you. We will call on as many folks as we can. And with that, I can get down to the business at hand. Our featured author today is Caley Horan, an associate professor of history at the Massachusetts Institute of Technology. She received her BA from Stanford University and her Ph.D. from the University of Minnesota, and she was a visiting fellow at the Princeton University Shelby Cullom Davis Center for Historical Studies. Her research, as we're about to hear, focuses on the history of risk and prediction, capitalism and business, and social life of economic ideas. And this afternoon, she'll be talking about her new book, Insurance Era, Risk, Governance, and the Privatization of Security in Postwar America, published by the University of Chicago Press earlier this year. Caley, the Zoom screen is all yours.
All right. Well, hello. It's a real pleasure to be here this afternoon. I guess I should start by thanking the National History Center, the Washington History Seminar, you, Eric, Rachel Wheatley, and all of the other organizers of the event. And thanks as well to Professors Devin Ferguson and Scott Reynolds Nelson for agreeing to offer comments on my work. And I guess thanks to all of you out there in the ether for showing up during this very hectic and stressful time. I do have a cold, and so I apologize in advance for any scattered thoughts and sniffliness that may occur. So I'm here to talk about my book, Insurance Era, and I do have slides, which I'll share now. Yes, okay, so the fellow that you're looking at on this first opening slide is H.R. Basford, the chief actuary of the Metropolitan Life Insurance Company from the 1930s to the 1950s. The photo was taken in Basford's office by a Life magazine photographer in 1947. And the image that you see in the background is actually a popular metropolitan marketing campaign that ran during the late 1940s. So this is one of many images I found during my research that didn't make it into the book. It's actually the only image on my slides, not from the book. And I've always really found this particular image fascinating and evocative. I think it captures something about the professionals and the experts who helped build the unique insurance system that developed in the United States over the course of the 20th century. And I think it also calls to mind the strangeness of insurance as a social and not strictly economic project. And insurance at its core, this is one thing that I argue in the book, is really an inherently collective pursuit. It's a way of sharing risk across groups. Of course, many Americans don't think of it that way, and instead tend to imagine insurance as a contract between an individual and a corporation. Why that is the case is one of the big questions that I hoped to shed light on while researching and writing the book. So my talk today will have two parts. It'll be very brief. First, I'll briefly discuss some of the major goals and themes of insurance era, and then I'll offer a very brief summary of the book's contents. It has 3 sections, and I'll say a little bit about each of them. And then after that, we can open things up for comments and questions, if that sounds all right. So major goals and themes of the book. The first major theme of the book is the development of the public-private insurance system in the United States. For many decades now, the US government has served as an insurer of last resort. It provides insurance coverage for groups and individuals that commercial insurers classify as too risky for participation in the private market. So this is a 2-tiered system in which the so-called bad risks are covered by the state, and less costly and more profitable good risks receive private and often superior coverage. So a big goal for me in writing the book was to ask, how did we get here? How did this structure develop historically? And to answer this question, I decided to study the insurance industry. This was a bit of a leap for me. I was actually trained as a cultural historian, but I quickly became fascinated by this industry and the profound but often overlooked role that it has played in shaping American life. So the first thing that captivated me about insurance is its role as a site of governance beyond the state. So that is, it's an institution that acts in many ways like a state by providing security, engaging in initiatives geared towards shaping conduct in the realms of health, education, and safety, by determining the boundaries of responsibility, setting the terms of legal liability, investing in housing, infrastructure, managing inflation, and the circulation of capital. I could really go on and on. So insurance acts like a state, but crucially, in the US during the middle decades of the 20th century, the industry developed an oppositional relationship to government. And this is something that I came across over and over again in my research. Leaders of the private insurance industry viewed government really as a competitor. So private insurers didn't simply offer an alternative to public insurance programs in the US. They consciously and purposefully sought to shrink the state and to check desire for public provision. So insurance industry efforts to limit American desire for a robust and inclusive set of public insurance programs really began immediately following the birth of the US welfare state in the mid-1930s. And the many ways private insurers sought to compete with the state is a major theme of the book. This was an ideological project, but also one that had real impacts on the built environment, on patterns like suburbanization and urban development, disinvestment, and decline. So the insurance industry played a much larger role in these processes than most Americans, and I would argue also historians of the US realize. So I ended up devoting 2 chapters to the industry's investments in cities and suburbs because the impact of those investments were really just so significant in shaping the course of residential segregation and racial inequality in the United States. Which actually brings me to a second major theme of the book, and that is the role of the insurance industry in perpetrating and perpetuating social inequality in the United States, largely through underwriting practices that classify risk and determine who gets access to insurance and all that comes with it. So healthcare, the ability to build wealth, to drive a car, to run a business, and so on. So the insurance industry in the US has historically served as a gatekeeper, granting and denying access to these important social goods without much public input. So if you live in a primarily Black neighborhood, you probably pay more for your home and your auto insurance than people who live in primarily white neighborhoods. If you're a woman, you most likely pay more than men for your health and disability insurance. And if you have very low credit score, you might not be able to get insurance at all. So if you look at this system and you extend it over the course of a generation or two, it's not hard to see how it has perpetuated and deepened social inequality in the United States. So social inequality linked to risk classification systems is actually a topic that's received a lot of attention from scholars over the past decade or so. But when I started writing this project as a dissertation years ago, not that much had been written about redlining. The process through which entire neighborhoods and communities are systematically denied access to insurance, loans, and other financial services. Thankfully, that's not true anymore. There's a lot of really great work now on this topic, and I think that that's actually quite wonderful. But much of the literature on redlining in the US places heavy emphasis on the role of the federal government, while largely overlooking private industry. So one of my goals in writing this book was to show that redlining and other forms of structural systemic discrimination in the US can be linked to practices of private corporations, as well as government policies. So for many years now, historians of the post-1945 era have depicted the federal government as the primary driver of social change and really the entity most responsible for institutionalizing racial segregation. So most historians rightly emphasize programs like the FHA in their research, and there are entire subfields devoted to the government's role in advancing suburbanization and making the suburbs a domain of the white middle class. So my goal with this book wasn't really to challenge this literature so much as to point other historians and readers in general toward private industry as a vitally important force in shaping social inequality and the segregation of the built environment during the post-war years. So the last big theme of the book is, I think, in many ways a product of the contexts in which it was written. I first began writing about this topic while working on my dissertation at the height of the Great Recession in the years following the financial crisis of 2008. And then I finished writing the book in the middle of a global pandemic. So both of these contexts, in different ways, led me to ask why Americans struggle so mightily, I think, to think of risk as something that can and should be managed collectively. And so in the end, it is a book about how Americans came to understand collective organization and collective risk sharing in particular as secondary to the organizing principle of individual responsibility. And I think there are clear connections here to resistance to vaccines and mask wearing in the US during our current pandemic. I think we're witnessing a failure on the part of many Americans to really understand that collective problems demand collective solutions, that individual responses to risk are insufficient when it comes to major threats like a global pandemic or, say, human-induced climate change. And so that failure, that way of thinking, has a history. And one of the major goals of the book is really to illuminate an overlooked chapter of that history, to illustrate how an incredibly powerful and influential industry, one that most Americans know very little about, to illustrate how that industry helped discourage collective and egalitarian approaches to managing risk and distributing resources, while at the same time elevating individual security over interdependence and collective risk sharing. So these are some of the big picture themes and goals of the book. I think I'll move on and just briefly, for just a few minutes, talk about some of the contents. So the book has 3 sections, each has 2 chapters, and it's structured both chronologically and thematically. So the 3 sections are selling self-made security, which looks at how insurers sold private security to Americans. Investing in privatization, which really examines industry investments in both cities and suburbs. And then finally, defending discrimination, which examines the industry's response to charges of discrimination and the strategies that the industry pursued when it was asked to reform its practices by civil rights and feminist activists. So let's start with selling self-made security. How am I doing on time, by the way? Am I good? Yeah. All right, so section 1, selling self-made security. You're looking at an ad created by the Institute for Life Insurance, which was one of the first institutional public relations organizations in the nation. It was founded in 1939 and managed all public relations activities for the life insurance industry and ended up producing thousands of advertisements and marketing materials over the course of the post-war era. So most of these materials sought to associate commercial insurance with individual responsibility, autonomy, and freedom. And you can definitely see that at work in the ad on the slide here. But the Institute for Life Insurance also worked to discourage Americans from demanding more expansive and robust public insurance programs. So this ad from 1952, for example, tells readers that through life insurance, you're building security for yourself and your family on your own. You're not depending on someone else to do it for you. So make no mistake, that someone else is the government. The Institute and individual insurance companies often turn to this kind of rhetoric in their marketing materials during the post-war years. They were deeply concerned about what insurance leaders called the trend towards statism, which is essentially growing demand for more public insurance programs. Commercial insurers went so far as to ask Americans to call on their elected representatives and request that they provide fewer benefits and services. And so this is an ad that I find particularly revealing, depicting a dapper couple sending off letters to their elected representatives asking for less government services. So this kind of direct political engagement can be found in insurance marketing campaigns throughout the post-war era. And I think that matters, actually. We can see in these materials the origins of narratives many Americans assume have existed forever. Narratives that tie private insurance consumption to individual responsibility and autonomy, while at the same time marking participation in public programs as a form of dependency. So this first section of the book also deals with another form of public outreach embraced by insurance companies of all stripes, public service programming. So life insurers were particularly active in the sphere of public health for most of the 20th century. So programs that offered medical advice and encouraged Americans to embrace healthy behaviors, for example, actively monitoring one's weight. These programs served a variety of goals for the insurance industry. First, they attracted goodwill for the industry by associating insurance companies with benevolence and public service. And second, they helped create a more healthy population that was less costly to insure. So property and casualty insurers also participated in public service programming. During my research, I really became fascinated by driver safety initiatives launched by auto insurers during the post-war years. So Aetna, for example, installed their Drivo trainer simulators in classrooms across the nation during the 1950s and 60s. And the idea with these simulators was, on one hand, to save money on claims, and on another, to attract goodwill by teaching young Americans how to drive more safely. But like many insurance public service programs from this era, the driver safety courses and these simulators also involved an element of surveillance. The Drivo trainer simulators actually electronically tracked student performance on driving tests. And then Aetna used this data from the classroom to sell policies and set rates. In fact, these simulators are actually precursors to the telematic devices that consumers are now installing in their vehicles to get lower premiums. Happy to talk about that in the Q&A. Okay, so moving on. The second section of the book looks at the investment practices of insurance organizations. So in this section, I essentially followed the money and found that insurance companies and life insurers in particular were major players in shaping the built environment of the United States during the post-war years. So one venue for insurance investment was urban housing. You can see an image of Stuyvesant Town and Peter Cooper Village on the slide. Life insurers were really convinced that they could build affordable mass housing in the 1940s, which they believed would create cleaner and healthier cities. So actually several of the urban housing developments built during that era by companies like Metropolitan and New York Life still exist and are widely considered kind of desirable places to live. So places like Stuyvesant Town in New York or Fresh Meadows in Queens. But many of the urban housing projects built by insurance companies also involved slum clearance, which devastated poor communities. Thousands of individuals and families were simply just removed from the sites where these projects went up and left with nowhere to go. And the private housing that insurers built there, often on formerly public land, that housing was closed off to low-income families and people of color. So Metropolitan's controversial whites-only policy in its developments attracted a ton of criticism, but the company won battles in the courts on the basis that its housing was private and thus immune to anti-segregation laws. So actually most of Metropolitan's urban housing properties remained 99% white well into the 1970s. By the early 50s, though, life insurance companies started to withdraw from urban housing. The properties were hard to manage. There was resistance from renters and also from civil rights activists, and that resistance attracted too much bad press. During the early years of the 50s, insurers began moving their investment dollars to the suburbs, where they dove into single-family home mortgage lending and almost single-handedly financed the shopping center boom of the 1950s and 1960s. They also built a ton of office space in the suburbs. The other image on this slide is a photo of the grounds of the Connecticut General Insurance Company headquarters. This is one of the first suburban corporate campuses ever built in the United States. It was completed in the mid-1950s. So shopping centers and suburban corporate campuses were huge areas of investment for life insurers. And that's actually something that I never came across in the historical literature on suburbanization and shopping malls. But I do think it's really important. I think we should know who financed these projects and why. So one of the things I tried to do with this section of the book is show how insurance companies brought their zeal for discrimination, for classifying, pooling, and sorting populations to their building projects. I don't think it should surprise us that an industry committed to separating populations into good and bad risks helped to expand and deepen patterns of race and class-based segregation in the built environment. But I do think this is something that historians have largely overlooked. Okay. Moving on here. So insurance companies, they're building these segregated housing projects in the cities, and they're building these suburban office parks. And at the same time, they're pulling money and jobs out of cities and contributing in a pretty serious way to the problem of urban disinvestment in the 1950s and 60s. So at the same time, they were constructing underwriting and risk classification systems that kept insurance coverage out of reach for many Americans, especially, but not only Black Americans. So by the post-war era, most life and property casualty companies had developed complex classification structures that charged different rates and offered different coverage for married and divorced people, non-married cohabitating couples, people with and without children, and of course, place of residence, biological sex. These were all used as classification categories in nearly all fields of insurance. Which really brings me to the final section of the book, which deals with insurance discrimination and the industry's response to civil rights and feminist activists who fought to reform insurance underwriting and risk classification practices, honestly, without a ton of success. So in this section, I focus specifically on the strategies embraced by insurance companies and insurance organizations when faced with charges of discrimination. And so one of the chapters of this section deals with the question of redlining and efforts to participate in urban reinvestment programs by life insurers. And the other chapter that's in this section deals with the feminist critique of the insurance industry. And actually the image on the slide comes from these debates over what was called at the time unisex insurance. And the industry really rallied around defense of their rating and risk classification practices in order to defeat legislation that women's activists and feminist activists tried to have passed that would make all insurance ratings unisex. And so what we're looking at is Aetna's response to these bills that women's activists tried to pass, our case for discrimination. There are tons of these things, these ads, lots of insurance companies participated in trying to defeat unisex legislation. But I think I'm running out of time. So perhaps we can discuss more about this final section and the other sections during the Q&A.
Thank you. If you could take down that slide, if you'd be thanked. Thank you very much. We have two terrific commentators this afternoon. The first of whom is Scott Reynolds Nelson, UGA Athletics Association Professor of the Humanities at the University of Georgia. His book about the life and legend of John Henry, Steel Driving Man, published by Oxford University Press in 2006, won 4 national awards, including the Merle Curti Prize for Best Book in U.S. History. It also has the distinction of having appeared as well in a children's version, as Ain't Nothing But a Man. He has written widely on the history of capitalism, and recent work includes A Nation of Deadbeats, published in 2012, and International History of U.S. Financial Crises. And Basic Books will be releasing his latest book, Oceans of Grain, How American Wheat Remade the World, this coming February in 2022. Scott, the Zoom screen, it's yours.
Thanks so much. So this was fantastic. I really love this, and why it is that a person who studies railroads and race would be suggested for this book is an interesting question. I want to suggest what I learned about this. So this is a fantastic history of a group of private institutions that have placed themselves in quasi-public roles that deploy socialized power but oppose state socialism, right? And then hide their tracks. So with great sleuthing, you see in Caley Horan's book, their hand in the white-only apartment complexes that contribute to urban blight, the creation of malls that favored just large firms. She does a great job of explaining how just the big firms get accepted into this mall system. Redlining and insurance policies, urban disinvestment in insurance in cities, even covert opposition to the ERA. And so what we see is that they kind of resemble other. So let me step back and suggest what's interesting, how this fits into a kind of bigger history before and after 1947 to 2000, which is this is primarily about. They resemble to me other socialized institutions that use quasi-public power. For example, railroads in the late 19th century, utilities companies in the early 20th century. And of course, internet monopolies in the 21st century. And only utility companies, because of the Great Depression, really, and because of tremendous malfeasance by utility companies in Chicago, and there's a great book called Panic in the Loop about that malfeasance, only those get taken over by the federal government, right? Only those get sort of government oversight. The others escape that, by and large, in the United States. And so we still have this sort of, you have professionals who kind of use their professional power. It's engineers in railroads. It's utility engineers in. It's interesting that you come from MIT because there's a lot of the role of engineering and expertise is an important part of how it is they get away with this, right? About being public institutions but actually being privately owned. The archive of their misdeeds, though, because they're not really public institutions, the archive of their misdeeds is almost invisible. And that's why it takes so much sleuthing to get this, right? That's why we don't, why I think many of the people who've written about redlining and written about FHA and things like that have missed this, because when we want to understand US government malfeasance in racial exclusion, all we have to do is go to the National Archives, right? And we find the internal records of those institutions. But those records aren't available to us, by and large, for insurance companies. That you really have to do all this kind of sleuthing around the edges, which I think you do a kind of fascinating job of capturing sort of how it is that they work and how it is that they hide their hand. So I actually worked for a while in a company called Cambridge Leaseholds that owned all the malls or managed all the malls in Canada on behalf of insurance companies. And so I kind of saw that from the inside. And this was a company that was just in absolute chaos, but you didn't know it because there wasn't any kind of public face to it, and there were no public records. And so they could just screw up again and again and again, do these horrible things again and again and again, and sort of get away with it. So for the US government's malfeasance and racial exclusion, we have the National Archives, but these records are not easily available. And so what we have here is a kind of stealth history of racial capitalism, of the kind of the hidden hand of racial capitalism in these very large firms. I want to suggest that in a way, this is a perfect complement to labor history. In a way, the deeper background of collective insurance is unions, right? Unions were initially organizations that were about collective death benefits, right? Some historians have called railway unions, for example, a death cult, because they were obsessed with the presence of death for workers in one of the most dangerous fields in the world at the time, in the late 19th century. And the social ritual that was a part of the Brotherhood of Locomotive Firemen and the Brotherhood of Locomotive Engineers and the collective death benefits, they were kind of risk pools. And in some sense, the tension between the locomotive firemen and locomotive engineers was the engineers thought that the firemen were in riskier jobs and didn't want to be in the same union, right? In part. So risk pools, you say that risk pools are a 20th century phenomenon, but in a way, they're kind of a little bit of an older phenomenon. the risk pool was really the individual brotherhoods, and the union's rules in sharing risk was displaced by Social Security and then by these life insurance companies, which sort of come in and displace the kind of that collective sensibility. Let me just a couple things about Cambridge leaseholds. I remember when I was at Cambridge leaseholds, we get this all hands on deck message saying that there was going to be a protest, a march in Toronto, that all the buildings had to be closed, all the stores had to be closed. They were going to call on more police, and no one was to go downtown who was connected with Cambridge leaseholds. Their framework for understanding the world was that any public movement was dangerous and needed to be stopped, right? And so the insurance company was, in that sense, a gatekeeper. But that gatekeeping is hidden because we don't really see, we don't, that there are a bunch of cops that show up. You don't realize that it's the insurance companies for the malls that are calling these cops. So one more thing about the past. So as someone who is a math major and always wanted to be an actuary, honestly, I love death tables. I really do. I was thinking about, is there always a dark side in life insurance? And I'm thinking about Eliza Wright, right? Elizurwright, who was an actuarial scientist, one of the first, whose interest in actuarial science led him to abolitionism, because he initially been interested in moving this. He thought that enslaved people could be moved back to Africa. He believed in colonization initially. And then when he looked at the numbers, he realized that this was impossible, right? That there's no way by sending a ship with 50 people at a time, you'd ever, change that world. And so it leads him ultimately to renounce his religion. He was extremely religious, and to become an abolitionist. And I wondered if there is a kind of, is there a light at the end of the tunnel? Is there a way in which the kind of science of life and death and danger and those sorts of things can be saved? And it finally reminded me of this, something called social data analytics, which is a new field in which sociologists and historians and political scientists look at the kind of fruits of AI that come in with R and Python when you run your scripts against very large data sets and you get these things. A social data analytics person is brought in to say, all right, okay, maybe it's true that the people who go to the biker bars are less likely to pay off their debts, but that's redlining, right? That's a kind of redlining. And maybe you should think about the ethical and moral questions of that. And so is there a kind of space for social and data analytics? So I love this book. It opens so many questions for me. And so those are the things that just kind of popped into my head as I was reading it.
Thank you very much, Scott. Our next discussant this afternoon is Devin Ferguson, who is the Strickland Distinguished Professor of History, Black Studies, and Public Affairs at the University of Missouri. Professor Ferguson received his Ph.D. in American History from Columbia University. He's the author of Liberalism, Black Power, and the Making of American Politics, published in 2009, and Land of the Fee, Hidden Costs and the Decline of the American Middle Class, published by Oxford in 2018, and the subject of a session of the Washington History Seminar back when, pre-pandemic, we actually met in person. His new project explores President Clinton's Presidential Initiative on Race, which is being co-authored with historian Nishani Frazier, who served as the personal assistant to President Clinton's Race Commission chair, Dr. John Hope Franklin. Devin is, I should mention, a former Wilson Center scholar. Devin, the screen is all yours.
Thanks so much, Eric. And also thank you to Christian Osterman and Pete Bakerstecker and Rachel Wheatley for organizing today's events. And thank you in particular to Professor Horan for giving us this timely book with changing demographics, particularly with the baby boomers aging and only getting older. The subject of insurance stands to only grow in importance and salience over time. And so in her book, The Insurance Era, Dr. Horan uncovers a market-pursuing industry that has actually led the way in investing, being particularly aggressive in investments of land and property. And then chronicling the sort of outsized role that insurers played in the land and property grabs in the first half of the 20th century, Dr. Horan offers a corrective to a common historical narrative. And as she writes, quote, that is that the role of the federal government as the driving force of home ownership, while almost saying nothing about the role of insurers. Now, the insurance era would arrive by the 1950s, Dr. Horan writes, but she also quickly adds, quote, not all Americans have granted access not all Americans were granted access to its promise. And so really the second half of her book is about sort of exploring or having a sort of exegesis in how insurance, which possessed sort of the nation's greatest reservoir of privately held capital in the mid-century, how insurance underdeveloped urban America. So how did insurance underdevelop urban America, according to Dr. Horan? Primarily, she looks at two factors or mechanisms, redlining and disinvestment. So while today redlining is largely associated with banks and realtors and mortgage lenders, Professor Horan properly reminds us that redlining was originally popularized by critics of insurers during the 1960s and 70s. And the impact that redlining had on home ownership was exposed by the Hughes panel. And this Hughes panel operated under LBJ's current commission, which was the second of the three major presidential commissions in the 20th century. And this Hughes panel studied barriers to property insurance in areas affected by the uprisings of the 1960s. And through its investigations, the Hughes panel sort of revealed that both urban homeowners and urban businesses were deemed, quote, too risky for standard investments, and either were, as such, sort of required to pay higher premiums or unable to secure any insurance policies at all. Now, the Hughes panel uncovered that many of the same urban areas that were redlined also found themselves actively experiencing what Dr. Horan refers to as community disinvestment. And by that, basically is the active outflow and transfer of wealth and transfer of capital from existing projects and services in cities and rerouted to neighboring suburbs through sundry means, including what the scholars have referred to as the mundane practice of, quote, the dispossession by administration, whereby routine procedural and technical choices made by middling corporate administrators often resulted in losses by citizens who are already experiencing economic precarity. So, for instance, an urban policyholder might see their premiums raised or claims denied as underwriters attempted to sort of recover loss of resources and monies because of discounts that were given or claims that were approved to suburban policyholders. And unlike their fellow financial travelers in the banking sector, which also has a long history of redlining and disinvestment, insurers were largely successful in escaping the regulatory oversight, despite, again, a similar history and practice of redlining and disinvestment. And perhaps for a new director, for some young scholar for future research, might be sort of addressing or asking, how did depository lending institutions and other credit intermediaries find themselves subject to a series of national policies? And here I'm talking about national policies such as the Home Mortgage Disclosure Act, or most infamously, the Community Reinvestment Act, or even the Equal Credit Opportunity Act, again, which was designed to curb discrimination against women originally. How did they find themselves subject to these particular policies that were dedicated to greater regulatory scrutiny, expanding access on one hand and also curbing abuses within the financial sector, compared to, let's say, the insurers, which effectively sort of walked away scot-free from any kind of federal oversight? Was the ability of insurers solely to elude comparable financial policing? Was it solely connected to the sort of McCarran-Ferguson Act? McCarran-Ferguson happens a decade earlier before McCarran-Walton. Or was it the gooey overlay that the insurance PR machinery had spent decades perfecting, which explains how the industry held financial cops at bay? Or possibly could it have been the reason that the insurance industry were able to sort of hold, again, at bay the financial cops Was there some kind of built-in structural advantage that the insurance industry itself has over the rest of the financial sort of sector? Again, that's more of a question for scholars out there or others who might want to pursue some comparable research. Now, had Dr. Horan's book stopped there, it would have been an important intervention in the histories of capitalism, urban studies, and political economy. But Horan extends her analysis, and this is where, again, I really have a personal thank you for my own sort of research, as she draws out broad implications for her project. Now, one of the added insights that Dr. Horan provides is documenting the exportation or outmigration of higher price insurance products from urban spaces to wider and wealthier spaces. What do I mean by this? That higher cost premiums did not stay in the urban core. Instead, Dr. Horan shows us that in the latter quarter of the 20th century, higher insurance premiums would be exported to a wider, wealthier America, out of insurers concerned that the middle class and even some upper income neighborhoods were too risky and speculative and thus less profitable. As Dr. Horan writes, quote, property insurers began the practice of advanced redlining that shifted wider, middle, and upper income households into bad risk categories, and with it to the path of insurance redlining, where they experienced, just like older redline communities, slower service, higher premiums, and a greater rejection of claims than conventional insurance plans. In this way, Dr. Horan's book is about the story of insurance is also a precursor for perhaps a more familiar story, and that is the story of subprime that will unfold a generation later, when high-cost financial products, once targeted to historically marginalized populations, would also begin to outmigrate to wider, wealthier households and neighborhoods. So whether high-cost insurance or high-cost mortgages, urban America might be seen as the canaries in the proverbial mine, alerting the public of a toxic atmosphere that, if not curbed, would ultimately affect the broader population. Now, like most thought-provoking books, the insurance era has engendered several questions. A couple of I will sort of pose here. Professor Horan, your book does a sort of masterful job at introducing the subject of race and insurance. Notably, it exposes a long history of insurance exclusion and wealth extraction. So what might scholars of racial capitalism learn about race and capitalism? And you can talk about these things differently, racial capitalism and race and capitalism, distinguish between the two, from your sort of excellent study of insurance. And how do you see your book informing, intervening, or interrupting studies of racial capitalism, which heretofore have been more or less silent on the role of insurance in the material experiences of people of color? Or put differently, what would you say is the big takeaway or big reveal for scholars of racial capitalism, whom, like you, are generally interested in the studies of capitalism for its social and cultural value, more so than its sort of financial sort of salience and relevance? A second question, last question, is that a generation of scholars have sought to put the state back into the study of history. Your work is a valuable reminder of the key role played by the private sector in shaping contemporary America. And I really do love how you do this, and I find your work and thesis very persuasive. That said, let's put the state back in for a second, at least wonder what happens if we put the state back in. And what happens if we extend your narrative to the Great Recession? And what relation impact more policies over the last generation, let's say Graham Leach Bliley, passed in 1989, or the Dodd-Frank Act, passed in 2010, two major significant pieces of financial legislation. What might these policies say about the making of insurance and our so-called second Gilded Age? For example, do these policies play no role in the making of insurance in the second Gilded Age, which is the age of deregulation? And if they don't, then does that suggest the increasing marginalization of the insurance industry from the sort of modern financial architecture? Those are the couple of questions and comments, but I'll just stop right there. And again, a remarkable book, and I feel privileged and honored to have a chance to read it and comment on. Again, fantastic job, Professor Horan. Excellent work.
Thank you, Devin. So before we open this up, Caley, you have two commentators with many points and questions. Perhaps you would like to respond to what they've had to say.
Wow, those are excellent comments. I'm so grateful to both of you for such generous, close reads of the book. Where to begin? Well, I guess I can, I'll start with you, Scott, because you were first. Well, first of all, on Eliza Wright, you should read Dan Bouck's work on how our days became numbered. He talks quite a bit about Wright and other, this kind of earlier history of actuaries and insurance practices at the end of the 19th century and the early 20th century. It's really good stuff. So you asked about the dark side of, well, does insurance always, private insurance always have a dark side, particularly life insurance? Well, I would say yes and no. Yes, because it's ultimately about death. And there's actually a lot of discussion of that in insurance marketing conversations. How are we going to sell this thing that makes people think about an uncertain and a not quite rosy future, right? But yeah, I mean, is there always a dark side? Well, it doesn't have, I don't think there has to be always a dark side. And in fact, I try to take some care in the book to be clear that some of the governing efforts of insurance companies to create, say, public health programs that encourage people to pursue healthier behaviors, to clean up certain kinds of environments. Like, these are good things to some extent, right? But you always have to think about what are the consequences and what's achieved through this kind of work, right? It's great to build affordable mass housing, but then if you make it for only white people, that's a problem, right? And so I don't think that it's necessarily that all private insurance always has to be a bad thing. But I do think that when particularly in the system that we have in this country, when it plays such a profound role in organizing social and political life, that we need to approach it critically and to think about the consequences of the power that these corporations exercise. And I like the discussion of railroads and utilities and this idea of quasi-public or private corporations and quasi-public roles. Sorry, there's a beeping going on outside my window. I'm not really sure what to do about it. Just bear with me, I guess. Moving on to Professor Ferguson. Wow, such fantastic comments. I'm very grateful to you as well. Yeah, this question that you offer about racial capitalism, how does this study fit within that kind of a literature? Well, I think one thing that's always really fascinated me about insurance is this kind of potent combination of qualitative and quantitative inputs that inform the decision that companies make about who gets access to security and how much they pay for it. So insurers, as we know, produce and draw on statistical data to make decisions. And well, scholars of statistics and quantification have been telling us for decades that statistics are not objective, and that the populations that companies like the insurance companies, for example, they put borders around populations, the categories that they're measuring. All of these things are subjective, and so I think there's how do I put this? To respond to this question about race and insurance, I do think that attaching objectivity to this question of objectivity, the idea of objectivity to these calculations is one of the ways that I hope my project and my research can inform studies of race and capitalism, because really that's. And I guess this can kind of answer one of your other questions as well. How did insurance companies elude oversight, right? How did, and this both of you kind of come at this kind of question. Is it McCarran-Ferguson? Is it the unique legal structure that structures the industry? Is it lobbying that goes on behind the scenes? Is it the wielding of expertise? This idea that insurance is boring, I think, is a major strategy to kind of prevent people from kind of looking in and trying to figure out what's going on, just because it's boring, nothing to see here, right? But again, it's this idea of objectivity, the objectivity of the statistics, which most people tend to believe in, when in fact, the statistics are not objective. They're highly subjective, and the way that we wield them are also sometimes very questionable. Lots more to say. I kind of wanted to sit down and have a long chat with both of you about this work, because it's so great to hear your thoughts about it. I feel like I'm maybe missing some. Oh yes, this question about financial deregulation in the 1990s and early 2000s from Professor Ferguson. Yeah, so one thing I can say about the GLBA, that's the Gramm-Leach-Bliley Act, and also Dodd-Frank, is that both the National Association of Insurance Commissioners, their stance is essentially that those acts both enshrined in federal law the McCarran-Ferguson Act. And so that's one thing that's like actually kind of important about this financial deregulation. This is kind of a sticky point, but it basically made these acts make the state regulation of insurance a federal law of the land, which is interesting. In terms of these deregulatory moves that happen, during the Clinton era and after, I think they contribute to kind of creating corporations that are too big to fail, which is something that insurance companies they were waving that flag and saying, "Oh, we're too big to fail," when feminists were asking them to change their risk classification structures. They were saying we're too big to fail when civil rights activists were saying you need to change the way you're distributing insurance in urban places. And so I kind of stopped the book in the mid 1980s because some of these changes, these deregulatory moves, actually they really changed the landscape of insurance in a lot of ways. There's continuity, but there's also a lot of change. A lot of the mutual companies turn into stock companies. But it's a somewhat different landscape. But I think the roots of the insurance system that we have today can really be found in this earlier post-war moment. There was one other thing I wanted to share with the two of you. Oh yes, the archive of misdeeds that Professor Reynolds Nelson mentioned. I should say that we need more work on lobbying, on corporate lobbying. And one of the reasons we don't have it is because it's very, very difficult to find evidence of lobbying. I actually found a lot of my information about the insurance industry's assault on unisex legislation in the 1980s. I found that in the tobacco archives. I don't know if anyone's been to the tobacco archives. They're really amazing. You can go online. They're housed by USC. And you can pretty much find anything you would like to learn about the United States in the 20th century in those archives. What I found was tobacco companies had hired some marketing specialists to help them kind of cleanse the image of the tobacco industry. And they had evidence of one of these targeted communications companies sort of making a pitch to big tobacco. And the example that they offered when trying to sell their services to tobacco was their work behind the scenes in lobbying and other kinds of work to tank the ERA and unisex insurance. But if I hadn't looked in the tobacco archives, which I wouldn't have found that information. So it's very, very difficult to trace lobbying, corporate lobbying. And I do hope that more work is done on that. And that's like enterprising sleuthers can dig in a little bit.
Thank you so much. We have two folks whose hands are up, and I am going to ask James Banner, friend of the seminar, to unmute himself and to join the conversation. Jim, welcome.
Thank you, Eric, and thanks very much, Professor Horan. I may have misunderstood you, but I'd like to ask for a little more substance and some clarification about, you implied at any rate that the American approach to insurance being a collective endeavor of pooling risk. You implied, I think, that it differs from insurance, the insurance ethos and approaches elsewhere. If I am correct, could you expand on that a bit? If I am incorrect in inferring that from what you said, then we can drop the matter.
Thank you for your question. I don't know if that's necessarily the case. I mean, I do think one of the launching points for me in doing this research was a comparison between the nature of the welfare state in the United States and in other so-called advanced liberal Western, capitalist countries. And I did sort of launch into this project wondering how it is that the United States does not have a more inclusive and expansive welfare state of the sort that other nations do. That doesn't necessarily mean that it's a different system entirely. I think what I was trying to figure out was there's certainly a long history of many people in the United States calling for example, a nationalized system of healthcare provision, national health insurance programs. There's been calls for that for decades and decades. And so the question is, how come those efforts have not been successful? And not the only answer, but one answer that I arrived at was that there was a very powerful industry that sought to prevent these things from happening and sought to kind of turn Americans away from a desire for more public insurance programs, for a more robust welfare state. Does that help?
Thank you. Michael Goodman has a hand up. I believe he has some experience with this industry. Michael, unmute and join the conversation.
Yeah, hello. My name is Mike Goodman. I was employed for roughly 10 years in a support position with the CUNA Mutual Insurance Group, which is an insurance company that specializes in working with credit unions, and its home office is in Wisconsin. It long had a reputation for being a progressive employer, but then that abruptly changed about 21 years ago. And at that time, a person was brought in from the 19th century to head up labor relations who had no experience in an insurance company. His experience was more with industries that employed blue-collar workers. And to make a long story short, things got very unpleasant. In my case, I became targeted because my position had just been abolished and I was in sort of a reserve floater status. And the policy of the company was to try to end that as soon as possible. And they resorted to all the dirty tricks they could to get rid of me, including a psychological exam and accelerated discipline and other bizarre factors. And the inevitable outcome was that I lost my job there. I think I could have understood if I had just been routinely laid off that would have been a business necessity. But all the crap that they put me through is inexcusable. And then the other worst thing about this is they attempted to deny me unemployment benefits. I had to take them to a hearing in order to get my benefits. And of course, the company didn't even bother to send a representative to the hearing because I think they knew what would happen. This company also achieved a unique record of acquiring 12 unfair labor practice citations from the NLRB. And given the notorious slowness of the NLRB to do very much, attaining that many complaints for unfair labor practices is really quite an impressive accomplishment. And basically, I now, since I'm active in the single-payer healthcare movement, I'm always willing to apply my experience and knowledge of the industry when people ask what are the problems or why isn't it advancing or who is holding it up. And it's definitely, in my opinion, the insurance industry, because they'll treat their employees the same way they treat anyone else. So I guess that's basically a capsule story of my experience. Thank you for listening.
Thank you for sharing your experiences there. I'm trying to, is there a question that I can answer for Michael?
He has just gotten off
Oh,
the line, but maybe
Yeah.
I can pose this, if I can. So he talks about labor relations, in the not distant past.
mhm.
Your book, in dealing with earlier years, unions don't make an appearance in these pages, but labor relations do. And I'm struck by the moment in which one of your Connecticut companies moves out to the suburbs and builds an architecturally award-winning, complex that someone once referred to as something of a country club. But labor relations, or at least the managing of labor, was on the minds of those insurance executives who, in designing layout and the open floor plan and the like, very much had productivity and observation in mind. Maybe you could contrast that earlier period with the experiences that Michael just offered.
Yeah, thank you. And also, Michael, I'm really sorry that you had these experiences. Sounds pretty awful. Yeah, I mean, I do talk a bit about labor in the book when discussing these office buildings, and it's important to, I guess, remind folks that the workers of insurance companies, really the vast majority of the workers for insurance companies in the early, well into the mid-late 20th century, were women. Before the computing era, women were the computers. And so these companies were managing large numbers of female employees. And one thing that I saw in my research was kind of efforts to govern and to shape the conduct of employees in lots of different ways by, for example, in these very award-winning suburban corporate estates, kind of creating lots of amenities for workers, and kind of essentially encouraging people to stay later, to do their shopping at their place of work, to show up earlier. I mean, there's the attention to employee conduct was brought all the way to the level of like the air that employees would breathe, and the circulation of the air in these places, the placement of desks, the decor, and all of it was designed to basically enhance employee productivity in different kinds of ways. And so there were critiques of this. But actually, one thing that I think, I don't know if this work is out there, if anyone knows, please tell me. Insurance companies were really like early leaders in like employee wellness plans, having exercise classes at lunchtime for their employees, encouraging employees to monitor their own health, and so I think that's something we've seen a lot more of over the last 10 or 15 years. But it would be really fascinating to kind of dig deeper into the early history of those kinds of efforts. And I think if we were to do so, we would definitely probably have to address the insurance industry as a place where a lot of those ideas generated. Yeah. Would the commenters like to add anything?
I think maybe to go back to one of the earlier questions about insurance and as how and when it coexists with social insurance, right? So when we have in welfare provisions, I forget who uses the term lemon socialism to describe basically socializing the things that are unprofitable and making those the state, and taking the things that are socialized and extremely profitable and giving those to private corporations. But it seems like there's a little bit of push and pull about to what extent do insurance companies ultimately need some underlying state institution to socialize risk, not just to make a profit, but also to do other kinds of insurance, right? Like insurance for housing insurance, for example, which doesn't make a whole lot of sense to do at the kind of national level or something like that. So is there a place for these institutions to? I suppose more generally, how would you govern them? What's a way that we could responsibly govern the way that insurance companies work, if that's what needs to happen, in a way that kind of makes their operations clear and allows us as citizens to really participate in that socialization, the socialized pool that all of us are in.
Yeah, it's a bit of a conundrum, this question of like what to do about risk rating. But I do think, there's a couple of options. I think one answer is to eliminate risk rating whenever possible, and to create more universal programs that harness what some philosophers have referred to as the utopian promise of insurance as a redistributive risk spreading technology. That's one option. I think that might be asking too much given the current political landscape in the United States. But I do think, that another option is to simply politicize risk classification, and to actually have a conversation about how we as a society want to decide how we care for members of society, to make unmask the risk classification as the political exercise that it is, and to stop kind of thinking of it as this sort of objective field that only experts can kind of wield. And there were folks who called for this in the 1980s. There were brilliant feminist legal scholars who were kind of looking at what folks at the time called the classification controversy and trying to figure out like what to do with this controversy. And ultimately, they ended up calling for politicization, to actually have a political conversation about the kinds of categories that we as a society think should be counted and should be used for classifications.
Thank you. We have a hand up with Teresa Ventura. If you would unmute, you may pose a question. Teresa? From my end, it looks like you're unmuted. But that's apparently not the case. All right. Try that again in a moment. Frederick Krimgold has a hand up and has had a hand up for a while. Frederick, if you would unmute, please.
Yes, I'm interested to know if you might be able to say something about the relationship of the insurance industry to climate change. It seems to be a case in which private insurers continue to insure and derive premiums from fossil fuel expansion, and the consequences on the other hand, are dealt with primarily by flood insurance, which is public. Have you considered that?
Thank you. Great question. Flood insurance is really fascinating. I need to read more on flood insurance. People need to write more on flood insurance. And one of the reasons I think it's so fascinating is, as you note, it's largely public and not private. And one of the reasons for that, or the primary reason for that, is that it is not profitable. And this is considered too unpredictable, but also not profitable for insurance companies, for private insurance companies. And so like right there, you see one instance in a larger trend, which is kind of kicking to the state those risks that are not profitable enough to insure, which is, you see this pattern kind of throughout the 20th century. So your question about climate change, I don't know. It's curious. I'm curious to see where we go with that, and if this massive collective threat leads to more interest in kind of public insurance programs the sort where we have public, flood insurance, will the threat of climate change lead Americans and others to start thinking about ways of managing those risks that aren't necessarily conducted for a profit and that aren't managed privately. I guess it remains to be seen. That's a really good question.
Thank you. Lisa Morgan has a hand up. Please unmute and join in. If you would unmute. Go ahead.
Hey there, no question here. Just most compliments for Dr. Horan. You're obviously quite intelligent, and then this work just shows the result of a lot of diligent effort, looking at all these resources, pulling together really disparate sources that, like the tobacco archives, that others haven't put together. And I won't take anyone's more time. Just utmost compliments. Thank you so much for this work and contributions to the field.
Thank you. We have a question in the Q&A from Elizabeth Shermer, who asks, I'm interested to hear more about why Dr. Horan chose to start this study in 1947 and how she sees her work complementing or challenging the work by Jennifer Klein and Sanford Jacoby on the 1930s and 40s origins of the public-private welfare state. And here she's thinking of Dr. Ferguson's important points about bringing the state back in. And she is particularly thinking about Jacoby's work on the importance of business elites, limiting federal support for social welfare, and the origins of both employers and unions relying on insurance and other financial products. How can the importance of those 1930s and 40s experiments as a kind of affirmative action for white men, a la Ira Katz-Nelson, in the importance of race and gender inequality be? There's a lot there. All yours.
Thanks, Ellie, for attending. Excellent question. Actually, the book doesn't begin in 1947. It begins with Wallace Stevens, the poet businessman, sort of thinking in an essay, one of his few insurance-related writings, thinking about how to respond to the passage of Social Security. So the book does begin in the 1930s with some kind of looking back to earlier moments in the beginning of the 20th century, dealing with the rise of industrial insurance, public health initiatives. All of that is pre-1930s. But the bulk of the book really starts with the passage of the Social Security Act and the birth of the American welfare state. And the idea there is primarily kind of like, how does this industry respond? How does this industry respond to what it identifies as a massive threat? In terms of the excellent literature that you list, I definitely see Jennifer Klein, Jacoby, et cetera. I see my book as complementing those books, not challenging by any stretch of the imagination, and hopefully contributing to the conversations that they've started by offering a kind of in-depth study of what's going on within these companies and within these organizations specifically. So thanks for your question, and it's a really good one.
Thanks. So I'm going to jump in here since I have a lot of questions of my own, and we'll try to squeeze in a few as co-chair prerogative here. And let's kind of build on what Ellie Shermer just raised. You begin the book with the poet / insurance executive, reflecting on the threat / challenge that public insurance, Social Security would pose to the industry, and reflections on how to respond to it. But over time, as you show in the book, the industry, recalibrates its thinking at times with regard to the federal government and its role. So sometimes it's hostile and wages campaigns, keep your money, keep taxes low, keep the state's hands off of our business. But at other times, it recognizes that it needs state cooperation, collaboration. It wants to control that. So the story changes somewhat over time in the book. Could you just say a bit about the industry and its attitudes toward the federal government and how and why it shifts over time?
Great. Sure. Thank you. Yeah. So in the early sections of the book, which trace an earlier period, leaders in the insurance industry are really quite concerned about nationalization, and they're very concerned about really expansion of public programs and ultimately also regulation. The threat of federal regulation is always kind of like hanging over their heads. And so there's a lot of almost constant discussion of how to compete with the state and how to shrink the state because it is this massive competitor in the market for security. By the time you get into the 1960s or so, particularly when life insurers start thinking about how to reform their public image by participating in urban reinvestment programs, they very quickly realize that, maybe private. So throughout the 50s, private enterprise can do the job is really like the mantra for insurance companies that are making all these investments in the suburbs. They're trying to show that private corporations can kind of act in state-like ways, can improve infrastructure and build housing. Why do you even need a big government when private companies can do all of this work? But then when life insurers go into these cities that they were actively disinvesting in and redlining, and they're like, we're going to solve this problem with this urban reinvestment program, they suddenly realize they need the assistance of government, that they need the government to help them insure the loans that they're making, and all sorts of other and in other kinds of ways. Life insurers also realize that the problems facing cities, again, largely problems that were that insurance companies played a role in creating, that those problems were not solvable through private corporate activity. And so rather than critique the state, which had been the idea for many years, insurance companies started talking about how this is the state's problem to deal with. Government needs to do more to help American cities. And so it's a kind of a bit of an about face. But you see similar trends when it comes to Medicaid and Medicare. The insurance companies were more than happy to see the state take on bad risks, to use their language, and to basically make it possible for private corporations to have a population base that was healthier, less risky, less costly to insure. And so in a lot of ways, there is this development over the course of the post-war era, towards the end of the 20th century, where this like government is always bad kind of message that private insurers were embracing, that kind of diminishes. And I think some of that is humility, a recognition that private enterprise cannot solve all social problems. But part of that was also kind of critique government when we don't need it, and support government when it's profitable to do so.
Thank you. Teresa Ventura tried to ask a question before, but her sound did not connect. So she's taken advantage of the Q&A function to write. I want to thank Caley for such a thought-provoking book and talk. I'm based in Montreal and once taught a comparative history of healthcare in the US and Canada. I was struck by how differently US and Canadian students experienced illness, with US students talking about feelings of insecurity, but also shame around illness. How might your history help us to understand the affective and emotional side of privatizing risk? And how might this work against moving from an individual to a collective understanding of insurance?
Thank you, Teresa, for that question. I think it's really fantastic. It's actually something I think about all the time. This idea of experiencing illness as something that's shameful, or finding it necessary to access disability insurance. All of this, this idea that to be sick in some way is a failure of the individual. If someone's sick, there's always in the U.S. there's this sort of almost knee-jerk reaction, like, well, is it your fault that you're sick? Did you manage your health appropriately? Did you take steps to not get sick? And I actually see that approach to illness, at least partially stemming directly from the rhetoric of individual responsibility that I talk about throughout the book. This idea that each individual needs to be their own private risk manager. And if you somehow fail in that task, it's your fault, and that you are responsible for that failure. And you see that at an emotional and affective level, and you see that at a policy level. And so it is this kind of shot through all the way. So I'm actually really, really grateful to you for raising that question, and this question of shame that surrounds illness and disability. I think it's really important.
Thank you. In the first part of the book, you use an example that struck me that I want to ask you about. And this has to do with the Institute for Life Insurance and enlisting the service of academics in the mid-50s. And you write about the Harvard sociologist Talcott Parsons, who helped shape the research agenda of the Institute. He comes and speaks on matters sociological, social and geographical mobility, changing gender roles, continuing waning of the extended family structure, the nature of society. And sociologists like Parsons, you say, were invited to speak at the Institute's annual meetings, and they introduced cutting-edge sociological research to the nation's top insurance executives. Quote, "We were essentially asking our business leaders to go back to college and major in sociology," one of your executives jokes about the history of the Institute. So my questions are this: was this research funded? Did the insurance industry purchase the talents of Harvard and other top flight academics? And how long does this tendency to draw upon scholarship persist? Is this something that they're continuing to do into the 60s and 70s, or do they generate it in-house like they do other things?
Oh, great question. I had so much fun actually reading about these academics that were hired by life insurers to teach them about sociology and psychology. And for me, that material was important for making a case that these were companies that were interested in addressing psychology and to shaping behaviors and doing so with cutting edge research, to support it. But were they paid? I mean, I assume that they were. And does this go on? I'm not sure. It strikes me as a particularly post-war kind of thing, this obsession with expertise and with experts. The marketing materials that insurers were making during this period, they were just pumping out, often involved advice from nationally known experts and renowned experts. I think on one level, it's a way of bolstering the claim to expertise that expertise in social and political as well as economic kinds of fields, to say that we have these experts on our side and these experts are helping us shape our approach to governing social life, which I think is super interesting. Is that still going on now? I don't know. Does anyone? I mean, I think I would be really interested. I mean, certainly academics are brought in to serve as consultants for industry all the time. I'm not sure about insurance today. Do either of the commenters have any thoughts on this question? Because it's a pretty interesting one.
I do have story to tell about. I was brought to Hong Kong in 2008 to talk by Credit Lyonnais Securities Asia to talk about the financial panic, because I had compared the 2008 downturn to 1873, and I said it was a cash crunch, not a gold domination issue, and then cash crunches look different in the 19th century. Debt deflation spirals are big and whatever, and so I gave this, and so at some point I was asked by Prudential Assurance to give a talk in Hong Kong, and it was at the top of a. So I got my pay was basically just the flight to Hong Kong, business class. So I didn't get any money beyond that, which was fine. I had never been to Hong Kong before. And so I was sort of talking about what a debt deflation spiral looks like and why a cash crunch is a big deal and those sorts of things, which is a kind of 19th century thing. And it's not, economists didn't talk about this sort of thing at the time. And somebody got up, and almost all men, with a couple of exceptions, all dressed in white. And somebody said, did you have any skin in the game in 2007? And I said, no, I mean, I have a retirement fund. And he said, well, did you make any changes? And I said, yeah, in 2007, I read that the European Central Bank was injecting 10 billion into the banks to get them to lend to each other. And I put our money in inflation-linked bonds. Bedlam, right? They're all yelling at each other, shouting at each other. My talk is over. And what the result was that they bought copies of all of my books, including Steel Driving Man and Ain't Nothing But a Man, the kids' book, and stuff like that, because they thought, and this is the sort of magic of expertise, is that they had this idea that there was some expertise in those books that they could use and monetize in some way, because they had lost billions, right, in this 2008 downturn, and they had some so there is a kind of belief in academics that's very, very, I think, runs very, very deep in those organizations.
So that's what I didn't do with my retirement fund back then. Oops. Well, live and learn. So let me pose just one more question, if I may. You deal with critics who challenge aspects of the industry's policies at various points. Don't put us into this category. You're misclassifying us in a number of cases. Can you just share with us, what you say in the book about the ways in which some of those challenges kind of reinforce the very structures that you think are problematic?
Sure. Well, I guess the best case would probably be the liberal feminist critique of risk classifications. Unfortunately, some of these liberal women's activists got into a debate about statistics with the insurance industry. And not everyone, not all women's activists took this route, but there was definitely a lot of discussion about whether or not insurers had accurately measured the women as a category. There was a discussion about exactly how many years longer women live than men, and this sort of there were arguments about the social this idea that gender is socially constructed, and therefore. Great, sure, but some of these activists inferred that basically women would eventually catch up to men and die at younger ages because they were doing more dangerous work. They were smoking and drinking more. They were interacting more, and so there were these also people who claimed that insurers were using old, kind of outmoded data that didn't accurately capture the lived experiences of American women, and therefore they should be forced to collect better data, which for me, I think Well, I'll give another example. Professor Fergus mentioned some of this advanced redlining that was going on by the 1970s. There's these like white neighborhoods that were basically in proximity to changing demographic areas, and they were redlined. And they said, no, well, this is impossible. They were sort of shoved into public housing insurance programs, and they said, well, the line is not in the right place. You've placed me on the wrong side of the divide. I'm a good risk, not a bad risk. In the same way that some of these women's activists were saying, you think we're worse risks than we are, we're actually better risks. And the problem with that kind of rhetoric is that as soon as you agree to the existence of good risks and bad risks, you're already involved in political decision making that is subjective and not necessarily effective, right? And so what we need to do is stop to accurately and maybe even more effectively develop a critique of risk classification in particular, is to sort of move away from this idea that we can have more accurate data. This is something that's we've got the Fitbits and the devices that we're using now to send data about ourselves to insurance companies. And the idea is that if we have more accurate data, if we collect more data, more accurate, more efficient data, that somehow that's going to lead to more fair, to use a term that insurance companies use quite a bit, more fair, more accurate, more objective insurance rates and classification categories. And I do hope that that's something that readers of my book take away, is that that's not, that this rhetoric of fairness is something that's kind of developed over time. It's an ideological response to critiques of discrimination. And in the end, I really do hope that that readers come to understand that we did not naturally, arrive at the rhetoric of fairness, or at a private insurance system that really underserves and excludes large numbers of people, of Americans, deepens and perpetuates inequality. I really do think that kind of exposing that this stuff is not just sort of naturally occurring, but instead developed over time. That if we can do that, and if we can understand that, we might be able to think about ways to distribute resources and manage risk more as a society. They're different, that we might be able to imagine more just, humane, and effective alternatives to risk classification structures that say there are good risks here and there are bad risks there, right? That hopefully, if we can denaturalize some of this and the narratives that were created and disseminated by private industry, if we can do that, that maybe we will have the courage to come up with a new way of doing things, if we can denaturalize first.
Thank you very much. I unfortunately have to draw this to a close, but I want to express my thanks to Caley Horan, Devin Ferguson, and Scott Nelson for this conversation this afternoon, and thanks to those of you in the audience who participated as well, and or just tuned in. Please join us next Monday, December 13th at 4 p.m. when the Washington History Seminar returns to explore Ladislav Zubak's just published book, Collapse, The Fall of the Soviet Union, with commentators William Taubman and Dina Feinberg. Till then, take care, be safe, and good night. Thank you.